Hey there, future Wall Street wizards! Ever looked at a stock chart and felt like you were deciphering ancient hieroglyphics? Don't worry, you're not alone. Charts can seem intimidating, but trust me, they're your secret weapon to unlocking the mysteries of the stock market. Think of charts as a stock's diary. They tell the story of its price movements over time, revealing patterns and trends that can help you make smarter investment decisions. By learning to read charts, you gain valuable insights into the minds of buyers and sellers, giving you an edge in the exciting world of trading. But why are charts so important? Well, they help you identify potential buying and selling opportunities. They show you the stock's momentum, whether it's gaining or losing steam. And they can even warn you of potential reversals in the market. So, buckle up and get ready to dive into the fascinating world of stock market charts. It's time to transform those squiggly lines into profitable insights. Let's start with the basics. Candlesticks and bars. These are the building blocks of stock charts, each representing the price action of a stock over a specific period. Imagine a candlestick. It has a body and wicks, or shadows. The body tells you the opening and closing prices for that period. A green or white body means the stock closed higher than it opened, bullish. A red or black body means it closed lower, bearish. The wicks show you the highest and lowest prices reached during that time. Long wicks can indicate volatility, while short wicks suggest a tighter trading range. Now, bar charts are similar but simpler. They use vertical lines to represent the price range and small horizontal lines on the left and right to show the opening and closing prices. Easy, right? Just by looking at the color and shape of these candles and bars, you can get a quick feel for the stock's price action. Moving averages are like trend lines on steroids. They smooth out price fluctuations, giving you a clearer picture of the stock's overall direction. Imagine a surfer riding a wave. The moving average is like the wave, and the stock price is like the surfer. When the price stays above the moving average, it's like the surfer riding high on the wave, bullish. But if it drops below, it's like wiping out, bearish. There are two main types of moving averages, simple and exponential. Simple moving averages, SMA, give equal weight to all prices, while exponential moving averages, EMA, give more weight to recent prices. Traders often use multiple moving averages with different time frames, like 50-day and 200-day, to identify trends and potential support and resistance levels. Crossovers between these moving averages can signal buy or sell signals. Volume is like the fuel that drives the stock market engine. It tells you how many shares are being traded, reflecting the level of interest and conviction behind a stock's move. Think of it like this. A price increase on high volume is like a roaring crowd cheering for a stock. Bullish. It shows strong buying pressure and confirms the upward trend. But a price increase on low volume is like a golf clap, not very convincing. Conversely, a price decrease on high volume is like a mass exodus from a stock, bearish. It signals panic selling and confirms the downward trend. Always pay attention to volume when analyzing charts. It can help you differentiate between real moves and false breakouts, giving you more confidence in your trading decisions. Section 5. Head and shoulders. Spotting a trend reversal. Now, let's talk patterns. The head and shoulders pattern is a classic reversal pattern that signals a potential trend change from bullish to bearish. Imagine a giant's head and shoulders. The left shoulder forms during an uptrend, followed by a higher peak, the head, and then a right shoulder that's roughly the same height as the left. The neckline is the key. It's a trend line connecting the lows of the two shoulders. When the price breaks below the neckline on high volume, it's like the giant's head rolling off, bearish. This signals a potential trend reversal and a good time to sell. Keep in mind that patterns are not foolproof. Always confirm your observations with other indicators and analysis before making any trading decisions. Section 6. Cup and Handle. A bullish brew. The cup and handle pattern is another popular pattern, but this time it's bullish. It signals a potential continuation of an uptrend. Imagine a teacup with a handle. The cup forms during a pullback from a previous high, followed by a shallower dip, the handle, before the price breaks out to new highs. The handle is crucial. It should be smaller than the cup and form on lower volume, indicating a pause in the uptrend before the bulls regain control. When the price breaks above the handle's resistance on high volume, it's like sipping from the cup. Bullish. This confirms the uptrend and signals a potential buying opportunity. Section 7. Double Trouble, Tops and Bottoms. Double tops and bottoms are like mirror images of each other, signaling potential trend reversals. A double top forms when the price hits a resistance level twice, failing to break through. It looks like two peaks of roughly the same height, forming the letter M. When the price breaks below the neckline, the low between the two peaks, on high volume, it's like the market saying, "Nope, not going higher, bearish." A double bottom, on the other hand, forms when the price bounces off a support level twice, failing to break down. It looks like two valleys of roughly the same depth, forming the letter W. When the price breaks above the neckline, the high between the two valleys, on high volume, it's like the market saying, "We're done going lower." Bullish. Section 8. Putting it all together. Chart reading in action. Now that you know the basics, let's see how to use them in real life. Remember, chart reading is like being a detective. You need to gather clues from different indicators and patterns to paint a complete picture of the stock's story. Let's say you're analyzing a stock chart and you see a head and shoulders pattern forming. The volume is increasing on the right shoulder, and the price is about to break below the neckline. This is a strong bearish signal. But wait, before you hit the sell button, you notice that the 50-day moving average is still above the 200-day moving average, suggesting an overall uptrend. This conflicting signal tells you to be cautious. Perhaps you should wait for further confirmation, like a break below the 200-day moving average, or a surge in volume on the downside before making a move. Section 9. Practice makes perfect. Honing your skills. Chart reading is a skill that takes time and practice to master. Don't get discouraged if you don't become a charting wizard overnight. The key is to start small and gradually build your knowledge. There are tons of free resources available online, including charting websites, educational videos, and even simulated trading platforms where you can practice your skills without risking real money. Start by focusing on one or two indicators or patterns at a time. Once you feel comfortable with those, add more to your arsenal. The more you practice, the better you'll become at identifying trends, spotting opportunities, and managing your risk. Section 10. Charting your future, a lifelong journey. Congratulations! You've taken your first steps into the exciting world of stock market charts. Remember, this is just the beginning of your journey. The stock market is constantly evolving, and there's always something new to learn. Embrace the learning process, stay curious, and never stop seeking knowledge. The more you understand about charts, the more confident and successful you'll become as an investor. So go forth, my fellow chart enthusiasts, and may your trades be profitable.